Well, welcome. We now have 16 people joining our fourth annual boot camp, option trading boot camp. And so I wanted to start off today, just kind of give me an idea. If you guys could give me each a 2-sentence summary of maybe what your experience is in either trading options or trading stocks, and just pipe in and we'll kind of do it like popcorn. So who would like to give me that first? Who would go first?
I'll go first. I have no experience with options. I have somewhat experience with trading stocks.
Okay.
I have various accounts. There you go.
Okay. And your name is Ron, and Ron is an attorney and a CPA and defends people with tax issues, right?
That's correct.
Okay. All right. Who's next? And kind of tell us also kind of what you do. One at a time, please.
Hey, I'm Tommy, or some people call me TJ when we're playing poker. I've been doing this for about a year. I got started with Dale. I dove right in the deep end. I don't like to take small bites at something when I go. I just get in there and take my lumps and learn. But I've learned a lot in the last year. I'm an airliner, so I'm trying to get out of that and focus on something else I can finish up with, and this might be it.
Nice.
Pretty good for a year.
And Tommy and I are regularly collaborating on what's called iron flies, and at some point you'll learn what those are. So who's next?
I'm Bob Banks, and I'm an art dealer, art appraiser, and I bought options. I deal in stock, but I bought options different times in my life over long investment, and I've always done really great at the beginning and then lost it all. And I've always been with somebody else who helped me through it, but so I'm always like had somebody holding my hand.
And Bob is a former owner of Banks Fine Art, so he traded in fine art. He loves to sail, and he spends most of his summers in Maryland sailing, right?
Yeah.
And Bob and I also have known Bob for a number of years, and we also have played poker together. So, all right, who's next?
Hey, I'm Trevor. I just listen to what James tells me to do. I have no experience in options. They go way over my head.
Well, Trevor, as I understand it, you guys have like a group of like Robin Hooders that have been trading some stocks. Am I correct?
Yeah. I just listen to James.
All right. James just tells you buy GameStop.
No.
At $20 a share.
He's not good enough for that.
Nothing like that.
He said to buy silver.
He says buy GameStop when it's trading at $350.
Uh-huh.
All right. Well, welcome, Trevor. All right. Speaking of James, then, is James here? James, you want to go next then, since, to follow up on Trevor's kind words?
He's muted.
He's muted. All right. Well, James gets to figure out his audio. Maybe James spent all of his money on GameStop, and maybe his audio.
Here he is.
Okay. There he is. James, you want to tell us about your experience with options or investing? All right, he's still muted. Either that or I've temporarily lost my hearing.
I'll go.
Okay, who's next?
I'm Greg, and I've been trading for probably 12 years. Not a lot of success yet. Traded stocks, options, and futures, and kind of lasted on futures, but still hadn't conquered that beast. Right. And now I'm pulling back to a new strategy with stocks, believe it or not, because I have a son-in-law that's having huge success with it. So I figured I'd try his momentum type stock plays. And obviously I can use options to enhance that if I can get it down pat. So it's really getting the training wheels off. That's the key.
And Greg owns restaurants, and he found me on YouTube. All right, Greg?
Yes.
Yeah.
Yes.
All right. Who's next?
I'll go. I'm Brandon. I own an AC and electrical contracting business. I've done currency trading, but I've never done stock options. So some of it, I'm curious to see if this relates in any way.
Currency as in Forex?
Yeah.
Okay. All right. Good. Who's next?
I'll go. Hey,
All
Brandon,
right,
I
Chris.
love the Seinfeld. I love the Seinfeld background, by the way.
Love it. Thanks, man.
Costanza, can't stand you. Costanza,
Can't stand you, baby. The big salad.
I was like, I know that house. Have I been there? No, I haven't. I have not been there. I watch that show. So my name is Chris Mutafov. I have a funny last name, and people call me the Lion King. There's many bar tabs across Dallas where people only know me as the Lion King, so that's what's on the bar tab. I have developed a career in sales over the past 10 years, and I've worked at a few startups, and I'm now working at a company named Splunk, and I manage the New York City, New Jersey, and Philadelphia areas for enterprise sales there. So
I met Chris. We were both on a homeowners association together, and Chris has shared many kind of Chicago bouncing stories with me. So we go back a few years. So who's next?
Oh, I'll go. I'll jump in.
Okay, I heard Nancy also say something.
That's fine. I'll wait till he's done.
Okay, who was it that spoke up? Was it Alex?
It's Alex, yeah.
All right.
Hey, Chris, I almost applied at Splunk a few months ago. So, yeah.
Let me know how I can help, bro.
Yeah, right. But no, I'm in software sales. Been doing that for going on 5 years now. I met Dale back in 2016. It's been a little bit in 2017, been a little bit now. I actually met Chris, Brian. Where's Trevor? Where'd he go? See if you guys in here I know. But I actually went through the last stock options boot camp you did a few months back. Right. So it's not exactly my first foray into it. I have a little bit of a base understanding, but it's nice to have a refresher.
Yeah. The first one I did, I just kind of threw people in the lake to teach them how to swim, and then said, hey, check back with me if you have any questions. The second one, I kind of taught a few things. And so it's kind of evolved to where we are today, where once a week I'll teach you a specific trade and you'll be practicing that week over 7 weeks. So I met the two Alexes where we had a stand-up comedy class together. So we did a showcase comedy performance. So that's kind of the angle. So there's like 3 circles of people that I know. There's stand-up comics, there's poker players, and then there's option traders. And some of you kind of are now entering into all 3 of those. So, all right.
I don't fall in any of those buckets, Dale. I guess I'm in the one category. Meathead.
Right. The meathead category when homeowners association kind of group. So who's next?
I can go next.
Nancy, good.
Yeah. I'm Nancy, and I work in audit for an insurance company, and then I trade options on the side. And Dale has helped me a lot with certain strategies, and otherwise I just do spreads, and he taught me the iron fly, and then I do covered calls. I mean, just long calls, but no naked puts or naked calls.
Okay. Welcome, Nancy. Good to see you back. So Nancy's always shy about wanting to put things up on YouTube. So I'm kind of, once she kind of makes a big trade, eventually she's going to invest in video so we can all see, who she is really. So who's next?
I'm Todd Dreyer. Can you hear me?
Todd, yeah.
Yeah, hey. So I have a little experience, just been stock trading for 20, 30 years. I do HR and treasury for a small oil and gas company over here in the Dallas-Fort Worth area. I know Dale through the poker playing aspect, and he's helped me a little bit trying to stay a hold of a few stocks. So I'm pretty new to the options trading and stuff.
Todd was lucky enough to catch a piece of GameStop before it went to the moon.
All right.
Right, Todd?
A little bit.
Okay. Congratulations on that. So welcome, Todd. Who's next?
I'll go. Hey guys,
Okay.
It's
right.
Ruffle. I'm here based in LA. I'm in the restaurant and bar business out here. Known Dale, I guess for about 15 years now, Dale.
Yeah, okay.
Through Buddy, but mainly through poker. And just started to get interested in options in the last year during COVID, since I had a lot of free time on my hands.
And Russell does restaurants in the LA area, right, Russell?
Yep, that's correct.
Okay.
All
right. So who haven't we heard from yet?
Hi, it's Max. So I have almost 2 years experience in options and around 15 in stocks. Live in Colorado right now, and I'm in IT business. But as a hobby, I see you like poker, but my hobby is to help Americans to elect new presidents.
I gotcha. and
Max, where are you from, man? I assume you're Russian after that.
Yep, from Moscow.
Добрый день.
Добрый день.
And Max, once again, you found me on YouTube. Am I correct? And then
Tommy sent me link.
Okay, Tommy sent you a link.
Yeah, Tommy from Facebook group.
Okay, good. All right. Is there somebody else we haven't heard from?
I'm Johnny Juiceball, or Johnny. I've been doing this for about a year or so. I've been long-term stock investing for about the last 10 years. I've got a stable portfolio, and I got into options about a year ago, and I've been learning from Dale for about the last 6 months, talking strategies and talking back testing and some stuff. And I've tried a little bit of the gamut of everything, and I kind of hope you guys do too, and you'll kind of find your own styles. And that's about it. I'm just here to kind of reinforce what I know.
And OJ is kind of a self-ascribed numbers guy, right? So he's always going, can you copy all those trades or blah, blah, blah. First, you kind of like spreadsheets, don't you, OJ?
Yeah, that's what I'm working on now. I love numbers, number crunching. I'm a financial loss analyst. I find holes where people are losing money, and I help them stop losing money. So
nice.
Numbers-based world, and so stock and options are too. And it's just patterns and algorithms, and I think it's all the same.
Yeah, and OJ and I were also poker players, and he's also involved in the mortgage business, right?
Yes, sir.
Yes, sir. All right, who haven't we heard from yet? I think there may be three more, or who have we not heard from yet?
I'll go. I'm
okay,
Brian. Hello. Minimal experience. I just do what James says, and I work in oxygen. So COVID has, needless to say, been great for business, but bad for mental health. And that's it.
Wow, James really has quite a following.
He's quite the lover.
Is he? All right. Well, that's another category. All right. Who haven't we heard from yet?
James.
Is James even here? Oh, there's James. All right, James, you got your audio working now? No. Okay. We'll just assume. Yeah, you do what James says, and he never says anything. So that's a real good strategy there. All right. Is there anybody else that we haven't heard from? All right. So me. All right. Dale Perryman.
Hey, Dale, question for you.
Okay.
It was on top of my head while you're talking. And so many of you are poker players, and so many of you are doing options. I just want to take a few minutes a minute to comment on options and how that relates to the gambling side of poker and that kind of thing.
Well,
poker's not gambling.
I'll speak for myself is that many poker players don't really consider it to be gambling the way they play it. I mean, table games, gambling, but a lot of poker, the analogy would be it's still a game that you play based on probabilities, and you can still get unlucky even if you're making correct decisions. The best thing to do is always focus on making best decisions. Some people say, I'd rather be lucky than good. Personally, I'd rather be good because it's more sustainable, because luck comes and goes. Brandon says no. So Brandon's going to do the podcast on the luck component, and he can kind of follow this with how to be lucky, right? So he can focus on that. So there's the short answer there. So I'm going to go ahead and do a screen share now for you folks and describe kind of what we're going to be going through over the next 7 weeks. So what we're going to be doing is, I would like to welcome each of you and thank you for joining it in this options trading boot camp. We're going to be having 7 one-hour Zoom meetings, and we're now 20 minutes into the first one. What we're going to do is we're going to learn one strategy every week. In 1 week, we'll learn 2. So we're going to practice each trade in your simulation portfolio that each one of you have sent me a link, and Mike has set up a simulation portfolio for each of you. All questions will be addressed in our weekly Zoom meeting or in the Slack group. In that case, I'll be the professor, and in the Slack group, you can post your questions and I'll be answering them there. Everybody will also receive a development plan. I've been in corporate training and development for the last 30 years or so. And one of the things CEOs across the United States were asked, what contributes most to the development of your future leaders? And what came out number 1 was a personal, individualized development plan. So what I've done is I've built a option trading development plan that's self-paced, that has a lot of the background information. And as those of you who are better students will actually do the homework, and you'll begin to kind of work through it. And as you have questions, we'll answer them on the Zoom call and in the Slack group. I realized that in the introduction, I didn't really introduce myself, but I am Dale Perryman, and I've been doing corporate training for the last 30 some odd years. And on the side, I have always been an investor. In 1988, out of graduate school, I took my first job, and it paid $23,000 a year. And I set a goal to save $10,000. And I accomplished that goal. To a large degree, the holdings that I have today and doing it full time was built on that first $10,000. In 1988, I invested in my first mutual fund, and I had to drive to the library in order to research it because there was no internet. In 2008, I remember I was playing poker in Atlantic City, and I watched my portfolio just hit this crater. And a buddy of mine who was working for a hedge fund said, "What are you doing to hedge?" And I said, "What's a hedge?" And so at that point, somewhere around 2008, I started selling covered calls, which is the first strategy that I started. And I did that for a couple of years. And in 2010, I wrote a blog post called "Double Your Money Every 2 to 3 Years Selling Apple Options." Starting in about 2012, I opened up my game and started doing more strategies. And so as of today, I have 15 different accounts that I manage for myself and family members, this is what I'm doing full time. So all questions are going to be addressed in a weekly Zoom or in the Slack group. We're going to have a trading competition. Mike has set up a leaderboard. We're going to buy in $20 a piece, and it's going to pay first, second, and third place, unless, of course, it's definitely against your religion. Maybe you belong to the 7-day millennial religion or something. So if that's the case, we'll let you play for free. So what we need to get started, I assume that everybody has already got an Ameritrade account. And the reason we're doing that is we're connecting to your TD Ameritrade account in order to get real-time data and to use it for the simulator. You've signed in to Trade Diff, you've connected your TD Ameritrade account, and you've created a simulation account. Is there anybody in this group who has not done that yet? I'm going to assume by your silence that you have done it and you've sent me a copy of your, a link, a URL to your simulation account. If there's anyone here who has not done that, get with me later and let's do that. So the trades we're going to learn over the next 7 weeks is we're going to learn how to sell naked puts, and we're going to learn how to turn that into covered calls through the wheel strategy. We're also going, in the next week, we'll learn how to sell naked calls and then do covered shorts, which is actually the reverse wheel. We'll then learn how to do poor man's covered calls. The reason it's called poor man's covered calls is it doesn't take as much capital to get started. We'll also do poor man's covered puts. Once again, it doesn't take as much capital. We'll learn strangles and straddles. We'll learn iron condors. We'll learn diagonals. And all of those may make no sense to you at all today. I don't expect it to, but over the next 7 weeks, we'll begin to kind of fill in that information so you'll know what those are by the end of the 7 weeks. A little bit about option basics. First, I'm going to talk about why should we want to trade options, and then understanding a little bit about the terminology, and then the benefits of being an option seller, of understanding liquidity and why it's important. So first off, why do I trade options? Well, first, it gives me more flexibility, because with an option, unlike if I'm just buying or selling stock, it has to go up, or you could short the stock and it has to go down. So with options, I could be bullish, I could be bearish, I could be neutral. The number one question people ask is, well, if you're neutral, how in the world do you make money? And the answer is in theta decay. And I know that doesn't mean anything to you, to many of you right now, but at the end of the week, at the end of 7 weeks, you'll understand how you could make money by being neutral. And so if I put it into a nutshell, why I trade options is because I can be wrong and still make money. I'd love to be able to play poker and be wrong and still consistently make money. I know Bob does that a lot, is wrong and still makes money playing poker. But, you know, and that's the reason we've nicknamed him Bob. Right, Bob?
Right.
Right. So it gives you more flexibility. The other thing I like about options is you can know your probabilities from the very beginning when you establish the trade. So I put on a trade today, an iron condor in Amazon, and I knew that it's got basically a 69% probability of profit over the next 38 days. I can't do that with stock. There's also capital leverage. So I can leverage more with options than I can with just trading stock. So there's a lot of terminology here. And when you first start, it's going to be like speaking a foreign language. It's going to be like if we went to Bulgaria and Chris starts speaking Bulgarian and you hear him say the following. Chris? Yeah, exactly what he said. Or, you know, and so you have no idea what he's talking about, right? Or it's like if you're a poker player and somebody goes, yeah, I was under the gun and he raised and, you know, pushed all in. And I said, I called, but he was bluffing. And you know, like, what are you talking about if you're not a poker player? So there's some basic terminology you'll need to learn, like what is a put? What is a call? What does it mean to be in the money? What does it mean to be out of the money? What is the strike price? What's the expiration date? What does it mean to be bullish, bearish, delta, theta, and the other Greek? So I will, in your development plan, will brush up on all that terminology. So, but let's start from the basics. And for those of you who already know, like, what is an option? An option is a contract which gives the holder the right to buy or sell a stock at some specified price and on a specific date. Now, that's the Wikipedia definition for an option. But an example of that, here's an example. Let's assume I'm a real estate investor, and there's 3 possible golf locations for a future PGA. I'm not really a golfer, but that's you know, that's a place, if it would be a good place to own property, right? If it was a future PGA. Did I get the terminology right?
Yeah.
Yeah. All right, so let's say I really only want lots that are going to be at the PGA location, but I don't know what they're going to select. And there's 10 lots for sale at each of these 3 locations. I expect the price at the selected site lot to go up by 5 times, but I have no insider information. You know, I don't have a connection like Bob has. So I'm not able to kind of get all that good insider info. So each lot is currently for sale for $100,000 per lot. So to buy all the lots, how much would it take me? 100,000 times 30, $3 million. So I'm going to use options, and I'm going to pay $1,000 a lot for the option to buy each lot for $105,000. That's out of the money. And that option expires December 31st of 2021. 1,000 times 30 is $30,000, making it rain. Follow me so far? Yeah, at least Ron is. So after the PGA is selected, I exercise my option and I buy the 10 lots at the selected location. 10 lots times 105,000 is $1,050,000. Now I've invested 30,000 in options and I purchased 10 lots for $1,050,000. Total investment, $1,080,000. I let the 20 lots at the non-PGA location expire worthless. I don't exercise my option to buy them because their current value is at $104,000, out of the money. And why in the world would I buy something for $105 when it's worth $104? I mean, I've played some poker with some morons in my life, but I don't know if anybody would make that deal. So I sell each of the 10 lots at the PGA location for $500,000 a piece. Total income, $5 million. $5 million minus $1,080,000 is $3,920,000 profit. Now that is one example of buying an option in a speculative way that actually made money. Questions? Now, it may seem that my simplified example is actually more complicated than doing it in a stock way, and I'm going to shock you.
I have a question.
All right, what do you got?
Well, I don't know if you're going to get into this later, but my question is doing that compared to just purchasing the stock. Like, I understand this whole example, but doing this versus purchasing the stock, you're going to make more money this way than just purchasing the stock. And why?
Because there's leverage. Rather than, let's say I don't have $30 million to buy all 30 lots. Let's say I've only got $1 million total capital, and I got to make it work. So that's what I meant by leverage. Plus, if I'm buying all these lots, now I got 20 lots that I don't even want, because all I really wanted was 10 lots at the selected PGA location.
So what the lots were 100,000. Why do you pay 105,000?
Well, because I bought it out of the money. See, people need a reason, and that's the reason I got them for $1,000. Because I assume that in 1 year, those lots are going to appreciate. And so there's got to be some incentive for the person that's selling you the option at 105. It's worth 100. You're buying it for 105. That's 5% more than it's currently worth. So it kind of takes into a value what 1 year's appreciation would involve. So there's got to be some incentive for them. And if I bought them for at the money, I'd be paying a lot more for it. Options at the money are a lot more expensive than options out of the money. Now, rather than questioning the economic viability of this, I think in a nutshell, it gives you leverage. Options give you leverage. And it also gives you a contract for something for the future. But I'm going to shock all of you here is I'm not going to propose that any of you buy options. What I am going to propose is that you be primarily the seller of options. And I'm going to say something crazy. Option buyers are primarily gamblers, and option sellers are primarily the casino. And I'm going to teach you a way to be the casino and not the gambler. Now, that's just my own philosophy, and all of you, and I can make an argument for that, and everybody can go out of here and still be a gambler, but I'm going to say get rich slow in a way with where the probabilities are in your favor. And just like a good poker player, you want to get your chips in the middle when you're ahead. And I'm going to show you a way to do that. So that is a call option. Now I'm going to explain puts. What is a put? A put, you can buy puts as a type of insurance. Buying puts gives you the right to sell at a certain particular price. Insurance is expensive. Amateurs buy puts when they expect the underlying to go down or they want to protect from losses. Professionals sell puts on stocks they wouldn't mind owning, so they can get it at a discount. Be the professional, be the casino, and not the gambler. Here's a put example. I find a coat that I like and the coat sells for $100. I sell a put expiring in 1 month to buy that coat at a strike of $90 and I collect $1. In 3 months, the coat's reduced to $90 and every one of those months I collected $1. I buy the coat for $90. I collected $1 a month for 3 months in option premium. 90 minus 3 is 87. So my cost basis for the coat is $87. Follow that example? That's a put example.
Why did Coke go down in price?
Well, it might have never gone down in the price. If it didn't, I keep collecting $1 a month for an infinite amount of months. And if that happens, I say, hey, you know, I really wanted that coat, but I like the $1 a month deal too. I'll use my old coat and I'll collect $1 a month for the rest of my life. So I don't necessarily have to have that coat. In fact, there's other coats. So it might not, Bob. But if it does, wouldn't you like it better at 90 than 100? Why did I feel like a Chris Rock when I said that? Wouldn't you like it better at 90?
But isn't it naked?
Yeah.
Okay.
Selling a naked put. And just like you're selling it naked. You're selling a naked put. And you might be naked because you don't have a jacket.
Or a camera.
Right. So, so this is an example of selling a naked put. So, little put background. Delta is a measure of how far an option strike is from the money. Delta gives us the probability of an option exercising out of the money. So a 30 delta option has a 30% chance of exercising in the money and a 70% chance of exercising out of the money. I like to sell options at 20 to 30 delta. So here's a trivia question. If there's 12 months in a year and you sold options every month, on how many months would you expect the puts to go in the money if you sold 25 delta puts? Based on what I just told you. This is a test to see who's listening. Anyone?
25.
20.
There's 12 months in a year, 25 delta puts. How many months out of 12 would you expect it to go in the money?
30.
Okay. 12 times 0.25 is 3 times. So if you're selling these like clockwork every month, you could expect it to go in the money 3 times. Now, what I'm going to explain to you now is what do I do if it goes in the money? You got 3 options. You could either buy it back, buy to close, possibly a loss. You could take possession of the stock, or you could roll it to another month.
Hey, Dale.
Yep.
Can you back up 1 second and explain again in the money and how that relates here?
How in the money versus out of the money?
Using this
At
example here.
the money is always 50 delta.
Okay.
Anything that's lower than 50 delta is out of the money. And once you use Thinkorswim, or once you start looking at trade diff, you'll see a number that tells you what delta it is. And in, let me give you an example of that. So let me go into my, and tell me if you can see this screen.
I can see it.
It says Dale's $1 Million Portfolio Challenge. Are you looking at that?
Yeah.
All right. So if I click on trade and I go in here and put in Apple, and then I pick the March expiration, and then I go in here, see how over here where it says delta?
Uh-huh.
A 20 delta is what I like to sell. So here's one that's 20, 26. So if you hover over it, this says sell, this one says buy, helps the dummy profit. So if I clicked on sell, so I'm collecting $1.70 per contract. Every contract is 100 shares. So that's basically, I'm collecting $170 to sell an Apple put. It's currently trading at 134, but if it goes down to 125, I'll have to either close that option or I'll have to buy 100 shares of Apple at 125. 125 times 100 is roughly what, 12,500?
Mm-hmm.
So that's how much I'd have to buy if I choose to take possession of that. So then I click submit. It sells that put in Apple. And then I've had you create groups. So you put these 3 dots here and you click on put it into naked puts. Now in the future, I want to teach you guys this. If you want to close something, you click on these 3 dots and you select the option that says close. That's how, and Ron had a premature where he sold Apple. You know, he watched my demo video and he sold Apple, right? And I said,
yeah,
we got a false start on number 53. We'll walk it off on the kick. We'll step it off on the kickoff, right? So I had him go ahead and close that. I wouldn't want you guys to think he had a head start. So here in that situation, here's a put and a wheel example on Apple. Apple's currently trading at 137. It was on February 8th. In month 1, I'm going to sell a 127.50 strike and I collect $2.40. The put expires worthless and I keep the $2.40 premium on one contract, which is $2.40 times 100, which is $240. Month 2, I do the same thing. Month 3, I do the same thing. Month 4, the option goes in the money. So what are my choices? I buy to close the put option. I take possession of the 100 shares of long stock at the price that I sold the put, or I could roll it. Roll it just moves it down the street and kind of hopes that something else happens next month.
How much could it cost to close, buy to close?
It depends upon to what degree it's gone up.
Uh-huh.
Right?
Yes.
So let's say it blows past it by $2. It would be about $2 to close it, plus any extrinsic value. Extrinsic is time value that's left. if it's a few minutes till expiration, it'll be almost all intrinsic value because there's no more extrinsic left. If there's still time left, there'll be a portion of it that's still extrinsic value. So let's assume I take possession of the 100 shares of long stock at the price the put sold. So I take possession of the stock at 145. So 100 times 145 is 14,500. So that comes out of my account. And now I have 100 shares of Apple. So then I turn right around and I sell 30 Delta calls against this stock. And I collect $2.90 or $290 a month for 3 months. 290 times 3 is 870 plus any appreciation of the Apple stock. On the 4th month, Apple hits the strike and I lose the stock. So now I'm going to start selling puts again and lather, rinse, repeat. And that's called the wheel. And I believe, Greg, you've heard about the wheel before. Am I correct?
Yes, sir.
Because I think you've asked me about it.
Yes.
So in the previous example, here's the financials. You sold puts for 3 months, $2.40 times 3, collected $7.20. You were assigned the stock at 145. So now your cost basis is 145 minus the 720 you collected, which is 137.80. You sold covered calls on it for 3 months. That's $2.90 times 3. So it's $8.70. So now my cost basis is, we take this 137.80, we subtract what we collected from the calls. Now my cost basis is 129.10. I started doing something similar to this in 2010 in Apple. I did it for 5 years on Apple. Guess what my cost basis was in 5 years?
So much.
Guess what it was?
Zero.
Zero. Yeah, it can't be that much.
Ron's saying specifically he believes that it can't be that much. Any other specific guesses? Like
it was
Ron's?
probably a negative. You probably made money on it.
It was minus $40.
Yeah.
Which basically means somebody paid me $40 to take every share of Apple I had at that time. I want to show you kind of what's possible. And that's why I wrote and if you need some documentation, you could go to this website, this jackofalltraining.com, double your money every 2 to 3 years. You could Google that term and you could read, as I kind of laid it out, what I was doing at that moment. So to demonstrate this, I just demonstrated selling a naked put for you in Apple. And so this is the wheel strategy. So what I want, the wheel strategy, you select a bullish stock, a stock that you're bullish on. And then you sell 20 to 30 Delta puts, sell put, sell put, sell put, boom. It hits the strike price. It goes down. Bob may say, what made the jacket go down? I don't know. I don't care. Who knows what? COVID, Apple missed earnings, whatever reason it goes down. And now you get the stock. And now I'm going to sell calls against that stock. Sell calls, sell calls, sell calls, sell calls. Boom. It goes up. It hits my call. I lose the stock. And now I revisit. Do I want to do it again in that stock or do I want to find another one? There's always another opportunity. Yep.
Would it make sense at all for someone with a small account to do a $10 stock or $20 stock?
I think it makes more sense for them to do a $10 or $20 stock than it does a 200 stock, person with a small account.
Okay. And are there costs associated with taking the stock is there a lot of cost involved in that?
Not a lot, but there is some. And the more you trade, the more everything is subject to negotiation. There are assignment costs. Currently, I've been doing it enough to where for options, I pay 40 cents per contract. I don't know, TJ, do you know what you pay for options? Maybe 60 cents?
Got it lowered. I want to say it's near you.
Okay. Other people have gotten as good as 35 cents. Every year or so, I call them and try to negotiate a better deal. You know, it helps if you kind of know what the competition's doing. They'll ask you, you know, what are you looking for? It's kind of like when you go buy a car. So knowing what you're looking for up front can help you.
Hey, Dale,
Yep.
I feel a little slow on this, but if you go back a couple of pages to your $145 stock that you sold and got $750 from, what makes that? Why does the option go in the money? What happens to the stock? Does it go down to 120 and then you have an option to sell it at 137?
Okay, remember I told you 25 delta option has a 25% chance of going in the money and a 75% chance of going out of the money. And we said that if you did that every month, approximately 12 times 0.25 is 4. So that's the reason I picked the 4th month it goes in the money. It's because I wanted to assess.
Can you put the numbers with the 145 to show me what in the money means?
The numbers with 145. So let me, what I can do is if Apple, somebody pull up a chart on Apple, tell me what Apple's currently trading at. Does anybody have access to that? It was trading at 137 on February 8th.
135.13.
So if I'm selling puts at 127.50, Apple's going to have to go down $9.50 before it hits the 127.50. At that point, my put is in the money. Now, calls are the opposite. I'm selling calls above Apple's price. So I'd be selling calls at least 140. So if Apple's trading at 137, it has to go up $3 before it goes in the money. Okay. So I know it's a little confusing, but in the money, if you're selling puts out of the money, it's below what its current value is. If you're selling calls out of the money, it's above where it's currently trading. Does that make sense?
Yeah. Yeah.
Does that help, Bob?
Yeah.
Okay. At the money is exactly where it's trading. So if it's trading at 137 today, at the money is 137. 138 on a call is out of the money. 136 on a call is in the money.
I got it.
Got it.
Hey, Dale.
Yep.
Got a quick question. So what is the variance, or what's your experience dealing with stocks that are trading at high dollar values versus a $5 or $10 stock? What's the risk reward?
Well, the primary thing to consider there is 2 things: volatility and liquidity. Liquidity is the difference between your bid and your ask. And you all want to be trading things that are highly liquid. If you're not, it's like going to a bad money changer, Chris, and you're wearing a Chicago Bears shirt. And you're like a Mexican money changer and they see you coming. Oh, senor, I have a special deal for you. You know, and your rate goes up.
You know, it's like getting into a Bulgarian cab and speaking English. It's not going to work out well.
Yeah, exactly. You're going to get gouged. So the idea is there are some highly liquid stocks that have a spread between the bid and the ask of 2 to 3 cents. That's good. If you get into some that have a bid and ask that's 30 cents, you may think 30 cents, no big deal. But on a 10 contract, take 30 cents and multiply it by 1,000, and how much you got? $30. And if you're trading in and out of that thing a lot, every time you're leaving $30 on the table, and it's like playing poker with Dallas Underground Rake, right? Where you chop a pot and you get less than what you started with. You guys know. Nod your head if you know what I'm talking about.
Oh, yeah.
Yeah. All right. So what other questions do you have? And I want to be sensitive to the time because I do want to keep these to an hour.
I got a quick one for you.
All right.
Your wheel trade, and I've run into this. What are the implications of dividends?
Dividends. you will never get assigned early except under the following conditions. They declare a dividend and the dividend is less, or the dividend is more than what it would, how do I say? They make more by taking your stock away from you. They make more from the dividend than it would take to take it away from you.
Say you collect $2 for your put and the dividend is $2.50.
Then it'll get taken away from you. Somebody gets the dividend for $2.50. They pay, you know, and you just, they made 50 cents by taking the dividend.
Is there any cases in which you lose and you're on the hook for the dividend also?
Yeah. If you're short the stock and somebody takes it for the dividend, you're on the hook to pay the dividend. Now, that may sound horrible, but when they declare a dividend worth $1, the stock will go down by $1 when they pay the dividend.
Right.
So it's a bit of a wash. Personally, I always get these emails that say, hey, you maybe have to pay the dividend if you know, it may exercise. I don't ever pay attention to those because essentially it's a wash because the stock will go down by whatever the dividend that's declared. Is that your experience, TJ?
Yeah.
Yeah. All right. So here's your assignment. I want each one of you, starting tomorrow over the next week, to sell 2 to 3 naked puts on stocks that you're bullish on. I would suggest that you do it on things that are relatively liquid, but if you choose not to, good luck with that money changer. And, you know, I want to establish some good principles along the way. I prefer selling puts, as I've said, at 20 to 30 delta. I prefer to sell highly liquid options. As I've said, highly liquid options have a smaller spread between the bid and the ask. I'll be giving you in the Slack group a list of the most liquid underlyings and ETFs. I'm also going to be posting in the chat group a development plan for each of you that you could go through on your own to learn some of this stuff, and post any questions on Slack. And I'll be answering those throughout the week and throughout the different 7 weeks. Now, what questions do you have?
Dale, I assume you'll be sharing the PowerPoint you went through with the rest of the team.
I would be happy to share the PowerPoint with the rest of the team. And I just realized that I didn't share this screen, but that's what this is. And I think that's the only one I didn't share, right? I stopped sharing. Okay, we showed the wheel strategy. Yeah, I'll be happy to post these into the Slack group. I'll create
what's the amount of the balance in the sim?
The balance in your sim portfolio is $200,000. And the reason is we all wanted you to all have enough capital to do all 7 strategies.
Are we spending all 200 on this?
You're not required to. One of their requirements is that you cannot put any more than 5% into any one trade. And the reason we do that, we don't want you just YOLOing it on all one trade. We don't want you you know what YOLO is, you only live once. It's the Wall Street bet guys. It's, you know, YOLO it on all one trade and kind of hope you get lucky. So we want you to apportion it. Now, Mike has set it up so that, let me see if he's here. He's not here. Mike has set it up so that you can't violate that rule. So if you try to make a rule and it's more than 5% and you see kind of a warning pop up, you know, you'll need to either scale down your trade or find a smaller underlying. So, you know, trading Google or Amazon, you may not be able to trade that, but most every underlying that's not a few $1,000s, you'll be able to pull off. Any other questions? All right, I'm going to hang around here till the last person leaves. I'm going to go ahead and stop the recording. I want to thank all you guys. What I'm going to do is don't leave yet, because I'm going to place a development plan and a reading assignment in your comment section each one of you download it before you leave today, but I'm going to go ahead and stop the recording.